So, Palantir is just crushing it. I mean, Alex is out there being Alex, and we love it in all those interviews. The stock is moving up and just blowing past every resistance line to higher highs with no end in sight. We got upgrades, we got S&P inclusion coming, and so much positivity that is making this a must-buy stock right now because it's going to 100 and beyond soon, right? Well, unfortunately, this setup is a setup we get a lot that sets up retail for that same situation that we fall for, which is buy high and sell low, and I'm afraid we may be seeing it once again. So I'll give you guys the truth on all this and tell you exactly how I'm handling Palantir stock specifically. Just make sure you like the video if you like getting the truth without the hype, because that's exactly what you're going to get today, guys. I'm excited just like you are about Palantir. Trust me, my accounts are all really excited. But nonetheless, we got to get down to the truth about what's going on. All right, so let's kind of discuss the so-called catalyst first, what everybody is all kinds of excited about. And then we'll talk about exactly how I think it may be setting you up for failure. And of course, we'll talk about exactly what to do about it. All right, so first up, we have S&P inclusion. All right, so we've discussed this before because of course, Palantir we thought was going to get in the S&P a few times and it didn't. And unfortunately, a lot of folks were very disappointed. They were very upset because unfortunately the media, some YouTubers, a lot of folks out there are pushing this as a quote unquote catalyst for the stock. And to me, it is not a catalyst for the stock itself. Now, and I'm talking about in regards to a long-term buy and hold investor's perspective. There are positives to it, but it is not a catalyst for the stock. Now, it is a trading catalyst because traders will absolutely trade it, but it is not a catalyst for the stock. And what I mean by that is when I look at Palantir, before S&P inclusion, post S&P inclusion, what does that do to the valuation of the stock? What value does that add to the stock? Tangible, that I can mathematically put to the multiple to include it? The answer is none. It doesn't add any revenue. It doesn't add any EPS. It doesn't, lower your margins. It doesn't do any of those things. It's not like magically you get included in the S&P and all of a sudden you get an extra $100 billion added to your market cap. You just get it. It's not how it works at all, but yet that is how it's presented, that it's somehow this massive catalyst that's going to send it to higher highs, which it does, and they've done the studies on this in terms of a trade. It is short term. It doesn't add anything to the actual valuation. If it's already overvalued and then it runs up even more into the S&P on the S&P trade, and at that stage, it'll either stagnate or go back down to what is actually fair value. It doesn't add any money to the multiple. You don't get a higher multiple because you're in the S&P. As a matter of fact, it goes pretty much the opposite because whenever you get in the S&P, typically you're a more mature company, not in your growth stage or in as high of a growth stage as you were before. And of course, the longer you stay in the S&P there means the more mature your company gets, which of course will mean your multiple over time naturally comes down. Not significantly, not this crazy amount or anything like that. But when you talk about catalyst to a stock, I don't see anything, and nobody has been able to show me anything anywhere where there's something tangible added to the bottom line. Now, we'll get to the positives here in just a second, but you have to keep that in mind with any catalyst. We see that constantly with Tesla. Tesla investors have gotten burned over and over and over again by believing the media and believing other people that are hype everything to the moon, that all these things are quote unquote catalysts when they're not. If it does not meet the spectrum, it does not add to revenue, it does not add to the bottom line, doesn't lower margins, doesn't do something to make the company more valuable, it is not a catalyst for the stock. Yes, it is a trading catalyst. Yes, traders are going to trade it, but statistically, there have been studies done on all this sort of stuff. They always return back to fair value in the end. Now, whether that's they stagnate for a quarter or two after the S&P inclusion, and then it comes up, then at that stage, we're back at fair value again, or if it comes back down off of that price to where we finally meet up with fair value. The point is that always happens in the end, meaning S&P inclusion is not a catalyst. Now, having said that, I think there is significant upside and positives to being included in the S&P. And the most important one is it helps stabilize the stock, the shareholder base. Your company gets more stable. Outside of Tesla, which seems to be the exception to all the rules, outside of Tesla, every other company gets less and less volatile whenever they become a part of the S&P, because then your stock goes from trader controlled, where all the traders are the ones that are mainly holding shares, over here to more institutional home because they have to own the stock. And more importantly, some other large funds over here. Remember the S&P, all your index funds, all those folks like that, they're not trading it out of stock. Sure, they're rebalancing and some things like that, but not trading it like hedge funds are. So it goes from that sort of trading activity over here to more balancing activity. And of course, you have other larger, more mature funds that aren't trading in and out of stocks. They may make a quarterly move. They may make only annual moves. Who knows? But they don't trade a whole heck of a lot. Those folks aren't even interested in a stock until they're into the S&P, meaning they don't even look at stocks that aren't in the S&P because they're going to let the S&P do the stock screening for them per se, and they're going to buy it once they're in there because they don't want to own a volatile up and down. They're not looking to trade in and out. They just want great solid companies. So they won't even start doing due diligence on Palantir until they're included in the S&P. And also remember, these things happen over the course of months, sometimes years as well. So it's not like S&P day happens here. Next day, everybody has to pile into Palantir, and therefore you're trying to get ahead of this crazy trade that's going to happen. It's not how it works in the end. That's the reason why some other folks pitch it as a catalyst and such. Whatever. Ignore all that sort of garbage. What it does for you is it brings stability to the stock because it starts taking more and more shares from the trader controlled over here to the institutional controlled and the more long-term buy and hold investors. It's all that it does in the end, which is great news. Of course, we want less volatility. I want better, shareholder base owning my stock. And this is another step in that direction. So that for me is a huge positive with S&P inclusion, but it's not a catalyst for the stock that adds $100 billion to the market cap or whatever gets pitched out there all over the place. Number 2, Analyst Upgrades. If you don't know how analysts work, one, they are not actually trying to analyze the company and decide what the actual price target is. They chase momentum in the end. And more importantly, they are told what to upgrade, what to downgrade, and all kinds of other things like that. You need to do some understanding and some actual analysis on these analyst upgrades. Do your research. They are there to put out a particular narrative that the traders have on out there amongst their bank or their fund or whatever the case is. It has absolutely zero to do with fundamental analysis and things of that nature. That's how come they can have just infinitely higher price targets on stocks that are at 1,000 PE and other ridiculous things like that. That's how that happens because they are simply chasing momentum and simply pushing a trade. That's it. There's not an actual ounce of analysis like we discuss here on this channel in terms of buying great companies. They are absolutely useless in the end. I don't care one bit what any analyst price target is or what the spread is on the price targets, or who has the high and the low and all that other junk like that. They are all playing a completely different game that if you don't understand that game, then you're going to get screwed because you think these guys have insight. You think they know what's going on. You think they understand these companies on a high level, and they don't. They're playing a completely different game. So analyst upgrades mean zero. What they do tell me one thing, and it's important, and that is they tell me where the momentum is. Now, you guys know, I remember forever, Palantir was a $8 stock, then a $7 stock, then a $6 stock, then a $5 stock, then a $4 stock. It just kept going and going and going and going. At some point in time, you're just going to go, this is ridiculous. I'm going to buy despite the fact the momentum's in the wrong way because I'm going to really like this price a few years later. And of course, that's exactly how it played out. But in regards to anything beyond momentum, them telling me what's going on, which by the way, any dummy can just look at Palantir this year and know that the momentum's up. So I don't need an analyst to tell me that momentum is moving in the positive direction for Palantir. How much longer can it go? Who knows? I'm not here to guess those things. I'm just here to brag great stocks at a great price. And that's it in the end. I don't care what analysts think. I don't care the least bit. I don't even look at it, guys. If I wasn't told in my group about it, I wouldn't even know that they existed. So something I completely ignore. And it's something, even though they're nice to see, understand beyond telling you where momentum is, which you can tell that just by simply pulling up a simple stock chart. You don't need to know anything else in regards to that. They don't provide any value. Number 3, the hype train is back. All right, guys, I'm seeing it out there. I'm getting sent all kinds of videos in my group in regards to CNBC, other YouTubers, articles, everybody out there saying, the craziest things about price targets for Palantir. Now that it's all the rage again, everybody's out there. Ooh, could it be at 50 by Christmas? And not to be outdone, somebody else says, well, I think it's going to be 70 by Christmas. And somebody else goes, oh, my ultra bullish case, it could be at 100 by Christmas. And it just goes on and on and on. This is called the hype train, guys. This is the stuff that gets us in trouble as retail investors because we're not sticking to fundamentals anymore. We're not even in the realm of reasonable at that stage. We are strictly speculating based upon the trade, the momentum, pretty charts and graphs, and we'll throw up all this other stuff like that, which maybe it does go to 50 before Christmas. That would be great. I'd be very, very happy. But then I'd be having to question the stock itself because, man, we just pulled forward probably an entire year, maybe more's worth of gains into the stock today. That's not good as a long-term buy and hold investor, right? Ask the folks that bought Tesla at 400, where it pulled basically, we're going on what, 4 years now? And we still aren't back, almost 4 years, and we still aren't back to just that high, much less all those other highs that were being predicted at the time. That's what happens when that happens to a stock. You end up with a dead stock potentially for years, and I don't want that. That is a terrible situation to be in regards to owning a stock. So we're not to those levels yet. We're not even close. I'm not saying that. We're just at a little bit overvalued right now. But that is definitely where the train is pointing. And then folks start buying it, not for a trade, not to trade the momentum, but oh my gosh, what this could be. And if it goes to 100 by Christmas, then all of a sudden it'll be at 200 next year. And just these wild speculations start that are way outside the realm of reality. And that's how people end up way overpaying for a stock in the end. We have seen it repeatedly. I've seen it repeatedly over 25 years, over and over and over again. I have made the mistake before more times than I care to admit over the years as well. So it's not criticism or anything else. I've done it too. Everybody has done it, but this is the exact setup that I'm seeing and the exact way it plays out over and over and over again. And yes, this has happened with Palantir as well. Why is this setting you up for failure? So this is important to discuss because you get caught up in the trap constantly, and we got to kind of discuss the trap here. Now, let's say you're listening to one of these deals, whatever the case is, you think Palantir is going to be at 50 by Christmas. Possible. I'm not saying it's impossible for sure. And of course, you buy it right now. And if it doesn't rocket up and continue to make good momentum towards that $50 mark, which would be significantly overvalued at stage, but nonetheless, leaving that aside for now, you get disappointed. And let's just say the stock falls back down below 30. Let's say, for example, it does that. What is going to happen to most retail investors when that happens? Unfortunately, they end up selling the stock. It turns into the classic buy high, sell low that we see constantly, guys. I've seen it repeatedly in Palantir over the years, but let's just look just this year. At the beginning of the year, the stock was at $16. I said by the end of the year, I thought it was worth, based upon valuation, based upon what Alex said in the earnings calls in terms of his guidance for the year, that it was worth in the mid 20s by the end of the year. Now, he's changed his guidance since then, so we've actually been able to adjust that price target up a little bit. But in regards to at the beginning of the year, that's what I said, mid 20s. And guess what? In just under a month, 1 month into the stock market year there, it was up around $25 or so in 1 month, which I immediately said, wow, that's awesome. But we just pulled forward the entire year's gains. Obviously, change of guidance has changed that, but nonetheless, at the time, that's exactly what happened. But everybody wanted a piece of Palantir at 25 because it was going to 30 and then 35 and then 50. And by the end of the year, it could be well over $100. Those were some of the narratives that were going on. So people bought then. But unfortunately, for the next 5 months, the stock did nothing except for go down. You were actually at the end of 5 months down 12%. In the meantime, there were plenty of other stocks that ran and, had double ups and more, 50% runs, 40% runs, whatever the case was. They had incredible runs during that time frame. So of course, I saw in the comments, I saw other folks that ended up buying high at 25 and then selling below that $25 mark, or as soon as it got back to break even, they got out because they didn't want anything to do with Palantir, bad stock, whatever the case is. All this, the normal narratives we tell ourselves whenever we are caught in that particular type situation, that's what ended up happening. And that happens on repeat where people buy high, they sell a little bit lower. It goes on another hype run where they then end up, because they love Palantir, buying again at today's price, $35, when they own shares at 25 and they just weren't patient with it in the first place, or average down, or whatever, all the other techniques that we'll talk about here in just a second in order to help out with that. Instead, they end up playing this rinse and repeat game with Palantir. Then you have folks kind of on the opposite end of the spectrum. We've had basically 2 years, a little bit more than that, to buy Palantir at incredible pricing. But yet they were so scared because it would have these nice run-ups and then dumps down, nice run-ups and dumps down, that they never actually bought shares when it was down or at any point in time, because they were afraid of the run-up and when do I make the right decision? When do I buy? When do I not? Whatever the case is, they get scared out of the stock in the first place. You should already have a full, if you love Palantir and you've been on the stock and been paying attention to the stock for the past couple of years, you know exactly what you own, and you should already basically have your full position built out at that stage. And a lot of folks never built out their position at all because they got scared, or maybe they bought one of the hype runs, it dumped, they got out, and they just weren't sure all the way around. So they've continually played this game of do I or don't I, because of those up and down cycles in the stock. And of course, everybody being super bullish on it, then super bearish, including some bullish and bearish YouTubers as well, kind of flip-flopping all over the place around the stock at times. It happens, and it creates this confusion with a lot of folks there, making it harder to buy. So they're not making the mistake of buying the hype run up and then selling, but unfortunately, they're making the mistake of just not buying a great stock at all, regardless of what the price is, because of the narratives around it, and seeing those dizzying highs and then the dumps down and the dizzying highs again. So how do you handle this? All right, I'll give you actually 2 strategies to use in order to do this. But before we do that, and before we get to those 2, I have to tell you guys, you have to ignore the noise, especially with Palantir stock, especially with the stock market in general. I couldn't tell you how many times this is the worst stock ever. It's going nowhere. And then on the flip side, it's going to the moon. It's going to be at 500 and then 1,000, and it's going to be a multi-trillion dollar, all this other stuff like that, which may be true in the future, but it's pure speculation at this stage. There's nothing today that tells me that's definitive tomorrow. And you end up with these massive hype cycles and these massive doom and gloom cycles, and you have to ignore both, guys. You have to ignore the hypers. That's how you end up buying Tesla at 400 and Palantir at 40 back in 2021, if you can believe that. Some folks were out there putting up their pretty models and charts showing how $40 was cheap for Palantir back then, and it was just utterly ridiculous. Great stock, terrible pricing at that stage, but everybody had the pretty charts and graphs and models and all that sort of stuff that showed it was actually cheap. All right, that sort of stuff, you can ignore all that. And same exact thing with the doom and gloom, guys. I've been doing this for 25 years, and the Great Recession 2.0 has been coming every single year since 2009. And guess what? Hadn't really happened yet, nor has this Great Depression or, Great Reset or any of the other crap that's out there all the time, every single year, by the way, which I like. Cool. I'm wrong once every, 8-10 years or so on average. Okay, cool. I'm right the rest of the time, meaning my track record is pretty darn good. Just ignoring those folks. Ignoring that sort of stuff is basically how you avoid hype cycles. But having said that, I only use two strategies to buy stocks, and specifically in regards to Palantir, let me just kind of illustrate to you how effective they are in regards to doing that. So the first one is a DCA, but before you go, oh, it's a simple DCA, skip on to the next part here. Let me kind of lay out why a DCA works in your favor in the end and why it's so powerful as you're building out your position. Let's just say you want X number of shares. You put your number out there. It's different for everybody, right? At full position for one person, it's 1,000. For another person, it's 10,000 shares. For another person, it's 100,000 shares. Depends upon your income, your goals, all the other things like that. Doesn't matter at this stage. Pick your number. Now, if you started buying Palantir, you had a year plus, just over a year, to buy shares under $10 per share. So if you just simply DCA'd during that entire year, you bought shares under $10 during that year, virtually every single time you DCA'd. You had a year where the pricing was under 10 bucks. So you've basically more than tripled up your money now, or more at this stage, depending upon what your average ended up being in regards to that, in regards to Palantir. That's how long you got. Then you got 8 months of buying Palantir under $20. So you had an additional 8 months to add shares. For most folks, basically, what would that be? If you got 8 months, that's basically, a year, more than a year and a half. Yeah, almost a year and 8 months, essentially, if I can do math right, where you could buy Palantir under $20 all day long. The vast majority of folks, if you just straight DCA'd during that time, you have all the shares that you want and more in regards to that stock. Oh, but by the way, you got more than 5 months after that time. If you were still DCAing because you were just adding bonus shares because you really love the company, you love the way they're executing, you got an additional 5 months to buy it under $30. So you're even up on those shares as well. That shows you how powerful a DCA is. And more importantly, you got the bulk of your shares when it was under $10. That's where the bulk of your shares came. And then as you started averaging up, well, your second longest length of time to add to this stock, you got 8 months under $20 per share. So you're more than doubled up on those shares. So it shows you why you just ignore everything, just simply DCA into a great company, and it takes care of you over the long run. It handles everything for you. And of course, if you believe this is a $50 stock or a $100 stock, and we'll say 3 years, 5 years, whatever time frame you have out there in regards to when you're looking out and calculating, hey, having a nice average at $35 today, not saying you're going to time top. It might very well fall down to 25 over the next, 3 to 6 months. Who knows? Doesn't matter. The point being, DCAers just simply DCA. When it went on a hype run, they bought. When it dipped heavy, they bought. It didn't matter at that stage. They just simply DCA'd. That's how you end up with a lower average than 99% of the people out there. And that's also why a DCA is hard to beat statistically. The models are out there. The samples are out there. A DCA is really, really hard to beat over the long run. Now, the second method is the one that I use most of the time, and that's called a modified DCA, meaning I am still DCAing with the stock, but I use price targets and valuations specifically. Now, remember, I've been doing this for 25 years. So for me, I won't say I'm awesome or anything at it, but I have a fairly decent grasp on the concept there. And whenever a stock gets overvalued, I simply stop my DCA. And then whenever a stock gets back to fair value or undervalued, I restart my DCA again. And as it falls further, I add heavier, meaning I am buying. You can look at a Palantir chart. You can go back and bounce it off the buys in the group there. I'm buying the troughs heavy. And then whenever it goes on hype runs, I lay off and I go focus on another stock that inevitably will be in a trough while Palantir's on a nice hype run. And I'll buy that stock. And that's kind of how I'm doing it. I'm kind of just buying the best deal at the time with what I have out there, and I use price targets to tell me where I should put my money at that particular point in time. That's how I stayed out of trouble with Palantir when it went on hype runs, regardless of what time frame we're talking about here. Even whenever it was under 10 bucks, it would have these nice runs where it would run up over right around 10, get up close to 10, and then it would fall right back down to $6, $7 again. It's kind of rinse and repeat there. Okay, cool. Kind of laid off as it was running up a little bit, and then as it fell down, I bought the fear again. Kind of rinse and repeat, the same exact thing. It's simply a DCA. It's just a DCA where I stop my DCA whenever it gets overvalued, and then I start it back again whenever it gets undervalued. And I kind of rinse and repeat that process. And if you want to work directly with me and my group of 6, 7, and 8-figure investors to learn exactly how to do price targets, how to do valuations, how to stay cool whenever the media is going nuts, how to actually do actual due diligence on a stock, understand price targets, understand what's actually going on out there in the market and everything else, make sure you check out the pinned comment down there. I may have left something special for those of you guys that have stuck around this long in the video. If you want access to my group where we have 5 free courses, you get the stock analyzer tool for free, you get free coaching, you get to be a part of the best 6, 7, and 8-figure Discord out there. Guys, so many exclusive videos, so many different things coming in the group. Just check out the pinned comment, see if a membership's right for you, check out what I left there, and see if you want to join. And click this video here if you want to see exactly what I'm buying in this market, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.